Rex Macey, Wilmington just came out with its capital markets forecast for the year. So is it going to be another good year for stocks?
It's going to not as good as last year, but we're thinking we'll see 8% total return. That's based on the fact that our 2015 earnings forecast about 126 for the S&P. We use the current forward PE multiple. That gives us 6% in price appreciation and another couple of percent for dividends, and you've got your 8%.
And is there a sector that you like the best?
We like the industrials, companies like Apple. You know, these are good companies. We think the growth will be there, and investors are going to be willing to pay for the growth.
And you're also a fan of international stocks. So how would you apportion your assets across the world?
Right. So we do like international. They're cheap. They're much cheaper than the U.S. market. We think the recovery in Europe will continue. We could see ultimately at some point the kind of PE expansion overseas that we saw in the U.S. last year. But we don't think that's immediate. And the momentum and sentiment favor the U.S. market. So we like the U.S. today, but longer term, we expect to be rotating into the developed markets. So we like developed markets a little bit more than emerging. They're going through some structural changes. The story about cheap wages and offshoring is over. As they adjust to that, we'd rather be in the developed international markets. So basically right now, most investors have a little bit of a domestic bias. So say it's about 60% US, 40% international. We'd expect to be increasing our international over time, but we want to let the US market run its course.
All right, and what about with regard to bonds? We've seen the 10-year strengthen, the yield go down over the past week after that December jobs report. What's your view for bonds? Where can you find yield in this market?
Well, you want to go with spread. We've got an accommodative Fed, you've got a recovery, the economy is doing fine. So it's okay to take credit risk. And when we look at high yield, if you're worried about rates rising quickly, which we really aren't, go to floating rate notes. Tax exempt investors, endowments, foundations those who invest in aggregate bonds, they really should be looking for more risk. We don't like the aggregate bond world, the investment grade bond world. The exception is for high net worth investors. With the increase in tax rates, we think municipal bonds make a lot of sense. That's a safe place to hang out, and you should be in a more normal stock bond.
Got a lot of money? Stick with munis.
That's right.
Thanks a lot, Greg.
Thank you,
Rex
Greg.
Macey. Thank you for watching The Street.